Well, the 2025 tax season is here, but don't worry, I've got you covered. In this video, we'll be covering the key changes to the standard deduction, updates to income and capital gains tax brackets, the impact of net investment income tax, and Medicare premium surcharges. Plus, I'll give you a couple strategies to legitimately keep your taxes down and put more money in your pocket. So let's dive in. Let's talk numbers. Back in 2017, the standard deduction doubled, allowing so many more people to skip itemizing in favor of a larger standard deduction. Now, according to TurboTax in 2025, nearly 90% of taxpayers claim the standard deduction versus itemizing. Typically, you're only itemizing if you have a combination of high medical expenses, mortgage interest, and state taxes. If you don't, you're probably taking the standard deduction. In 2024, single filers get a $14,600 standard deduction, while married couples filing jointly receive $29,200. But 2025 brings meaningful increases. The standard deduction for single filers rises to $15,000, while married couples filing jointly see theirs jump to $30,000. Seniors also benefit from increased additional deductions. For those people 65 and older, in 2024, you get an extra $1,950 if you're single and $1,550 per person if you're married and file jointly. In 2025, that increases to $2,000 for single filers and $1,600 per spouse filing jointly. Now, while these incremental increases might seem small, they play a crucial role in reducing taxable income and ultimately lowering your tax bill by hundreds of dollars. All right, here's a critical truth that many people misunderstand. Many people believe that all of their income is taxed at the highest tax bracket their income puts them in. But in the United States, we have a progressive tax system. That means that your income is taxed in layers, like that 7-layer dip that you ate at that Super Bowl party. Each layer is taxed at a different rate, with that rate increasing as you earn more income. The deeper that chip dives into additional layers, the more taxes that are taken out. The last time tax brackets changed significantly was in 2017, but those brackets are up for review in 2025, and there will be more to come later in the year on a tax plan. For now, in 2025, tax bracket thresholds will increase by approximately 3% due to inflation, helping to combat the effects of what's called bracket creep, which happens when inflation pushes you into higher tax brackets without an actual increase in purchasing power. These changes give taxpayers more breathing room and help you avoid paying higher taxes on inflation-adjusted income. In 2024, if you're single, the first $11,600 of income after your standard deduction is taxed at 10%. From $11,601 to $47,150 of income, you're taxed at 12%. Then the bracket really jumps. From $47,151 to $100,525, you're taxed at 22%. Then from $100,526 of income through $191,950 of income, you're taxed at 24%. From $191,951 to $243,725, it jumps significantly again to 32%. Then from $243,726 to $609,350, you're taxed at 35%. And finally, any income above $609,351 is taxed at a flat 37%. Here's an example of someone who makes $58,000 of taxable income. After their standard deduction, this first layer is taxed at 10%. That's $1,160. This layer is taxed at 12%, or $4,266. And this layer is taxed at 22%, or $2,387. That's $7,813 in total taxes, or an effective tax rate of 13.47% for this single person making $58,000. Even though their income puts them into the 22% marginal tax bracket, not all their income is taxed at that 22% rate. So how does this compare to 2025? Well, so far, each of the tax rates are the same, but that may change depending on the tax policy of the new administration. What did happen is that each income bracket level moved higher by about 2.8% to adjust for inflation. When we look at 2024 and 2025 side by side, you can see that for singles, the 10% bracket moved from $11,600 to $11,925. The 12% moved from $47,150 to $48,475. 22% moved from $103,350. 24% moved to $197,300. 32% moved to $250,525. 35% moved to $626,350, and any income $626,351 or over is taxed at a flat 37%. When looking side by side at single and married brackets, you can see the immense advantage given to a married couple. So if you're watching this, get married. Just kidding, but not really. You'll see that married tax brackets increased to $23,850, $96,950, $206,700, $394,600, $501,050, and $751,600. Again, the key bracket to look at is if you can keep your taxable income below $96,950 if you're married and in the 12% bracket before it jumps to 22%. Or under $394,600 and in the 24% bracket before it jumps to 32%. These are the two areas that I like to call the sweet spot in the tax code. Now, these brackets apply to what is generally called income. This is your wage income, or if you're self-employed, your net business income. Any interest that you receive from a high-yield savings account, a portion of Social Security income, short-term capital gains, or your retirement plan distributions like a traditional 401k or IRA. All of this income gets taxed at income rates. But what about capital gain? Capital gains taxation remains a key area for strategic planning, but it can be tricky and it's less understood. Long-term gains from investments held over a year are taxed at preferential rates. That's why it's really important to know how long that you've held an investment before you think about selling it. Let's say you had an investment that you bought for $2,000 back in January 2024. If you decided to take a trip this year and you sold that investment for $2,700 in 2025, you would have a $700 capital gain. As long as it was sold sometime 12 months after you bought it, you would qualify for special treatment. One essential point to understand is that long-term capital gains are treated as taxable income, but not ordinary income. What that means is that they do impact what tax bracket you're in, but because they are not ordinary income, the rate on which you are taxed on this capital gains income is different. Let's dive a little deeper. For 2025, a single filer with taxable income up to $48,900 and married couples up to $97,000 pay zero in capital gains taxes. That means that if you sold that investment with a $700 capital gain and were under these income levels, you would not owe any capital gains tax. If you make over these levels, but below $533,400 of taxable income if you're single, or below $600,050 if you're married, then you pay 15% on these gains. And if you make above those levels, you pay a 20% capital gains tax. This is where good financial planning can really help. Planning your income wisely can help you create a nice retirement income and stay within favorable capital gains brackets to avoid paying unnecessary taxes. For example, let's say that you're married and you're retired and you are both over the age of 65. Combined, you have $50,000 of taxable IRA distributions and $50,000 of taxable Social Security benefits. Your combined standard deduction will be $33,200 in 2025. That would mean that based on this income, you would have $66,800 of taxable income. Now, let's say you own some Apple stock that you bought years ago for $10,000 that's currently worth $40,000. you would have $30,200 of potential capital gains income before you would be taxed on it. You could sell all the Apple stock and pay zero tax on that gain. Then, if you wanted, you could rebuy the stock and reset your cost basis higher moving forward. That's some outstanding tax planning. You know what isn't outstanding? Not subscribing to the #1 personal finance channel on YouTube. This one, See the Forest Through the Trees. So take a quick moment to like this video and hit that subscribe button. Thanks for doing it. All right, let's talk about net investment income tax. This tax is catching more and more people every single year. You know why? Well, unlike most other tax brackets, this one isn't being increased each year by inflation. Ouch! This is a 3.8% tax that applies to your investment income if your modified adjusted gross income exceeds certain thresholds. Most often, this is not affecting retirees. It is most often affecting people like Gen Xers in their highest income earning years or people with large gains in certain years. For single filers, this threshold is $200,000, and for married couples, it's $250,000. This is a tax that's on interest, dividends, annuity income, rental real estate, and capital gains that are passive. It also includes gains from selling your primary home that exceed the exclusion amount. Form 8960 is the form that can help you calculate whether you would owe this tax. Now, if you're close to that income level, you may want to explore ways to better manage your passive income. Instead of high dividend stocks, you might invest in lower dividend, higher growth stocks in your non-retirement accounts. Tax-free municipal bonds aren't taxed at the income level and don't contribute to the net investment income tax. You could contribute more to your retirement accounts or an HSA to get more of a deduction. You could also try to defer income into next year and accelerate deductible expenses into the current tax year. These are all strategies that could help you avoid this tax if you are close to those thresholds. Now we are going to tackle one of the biggest pain in the butt taxes there are, the IRMA Medicare surcharge. And when I take on a new client, I find out that many people aren't familiar with how this tax works. And the tricky thing here is that if your modified adjusted gross income exceeds these levels by even $1, you could end up paying thousands more in Medicare Part B and Part D premiums. Good financial planning means taking into account IRMA thresholds. To figure out whether you owe the IRMA surcharge on your Medicare Part B and D in 2025, they look at your modified adjusted gross income from 2 years ago, back in 2023. This one is different. It isn't your taxable income, it is your modified adjusted gross income, which is basically all your income before deductions. If you're single in 2025, if your income is higher than $106,000, or if you are filing a joint return and earn over $212,000, you will be paying higher Medicare premiums. You can see that as your income increases above these levels, your Medicare costs increase higher and higher. You can also notice that these thresholds increased right about 2.9% from 2024 when they were $103,000 and $206,000. It's important to remember that the IRMA surcharge is calculated each and every year. So if you have an abnormally high income one year from selling a business or taking a large retirement distribution, your IRMA can actually go back down or completely away the following year if your income falls back down. All right, that about does it for the important tax updates to 2025 at this time. Remember, tax planning isn't about looking back, it's about looking ahead. Think of it as navigating a complex road where you're constantly scanning the horizon and making adjustments based on what's coming up ahead. While you want to check the rearview mirror to reflect on your past moves, your focus should always be forward. And make sure to check back later this year when we have more clarity on the current administration's updates to the current tax law. And if you own a business, you can get started working with me today by visiting celestialwm.com and clicking the Start Here tab. And while you're there, don't forget to head to the Resources tab and download my 7-step guide to building your financial path. It's packed with strategies to set you up for success. And be sure to check out this video next for even more ways to supercharge your net worth.